There's a number that gets thrown around in trading circles, 90%. 90% of traders fail. And while the exact percentage varies depending on who's collecting the data and how they define failure, the broader point stands. The overwhelming majority of people who try to make money from trading don't. But here's what's strange. When you talk to new traders, people in their first year, their first 6 months, and you ask them if they think they'll be part of that 90%, almost none of them say yes. They know the statistic, they've heard it, they might even repeat it to other people. But when it comes to their own trading, they don't actually believe it applies to them. And that right there is the Dunning-Kruger effect in action. Let me explain what this is, because once you see it, you can't unsee it. And more importantly, once you understand how it works in trading specifically, you can start to inoculate yourself against it. The Dunning-Kruger effect is a cognitive bias identified by two psychologists, David Dunning and Justin Kruger, back in 1999. They were studying competence and confidence, and what they found was striking. People who are genuinely incompetent at something tend to be the most confident in their abilities, not slightly more confident, wildly overconfident. And the reason isn't arrogance, it's ignorance. When you don't know what you don't know, you can't accurately assess your own skill level. You lack the very expertise needed to recognize your own incompetence. Think about it this way. If you hand someone a guitar for the first time and they learn 3 chords, they might think they're halfway to being a musician. Because from where they're standing, playing music looks like playing chords. They don't yet understand rhythm, timing, dynamics, music theory, ear training, or the 1,000 other layers that separate a beginner from a professional. Their incompetence prevents them from seeing how incompetent they are. Now, apply that to trading. A new trader opens a demo account. They learn about support and resistance. Maybe they pick up a moving average strategy. They take a few trades, some work, some don't. But over their first month, they end up positive. And in that moment, they think they understand trading because they don't yet know what competence in trading actually looks like. They don't understand position sizing, risk-adjusted returns, sample size, edge decay, regime changes, psychological resilience under drawdown, or the difference between being lucky and being good. They see the surface, and the surface looks manageable, so they move to a live account. They increase size. They start thinking about quitting their job, about trading for a living, about financial freedom, and then the market humbles them, hard. Here's what the research shows. Dunning and Kruger mapped out a curve, and the curve goes like this. When you first start learning something, your confidence spikes quickly, way faster than your actual competence. You know just enough to feel capable, but not enough to realize how much you're missing. This is called the peak of Mount Stupid, and almost every new trader climbs it. Then, as you gain real experience, as you encounter complexity, lose money, face situations your simple model can't explain, your confidence drops. Fast. You realize how much you don't know. You enter what's called the valley of despair. This is where most traders quit. They thought it would be easier. They thought they had it figured out. And when reality punches them in the face repeatedly, they conclude that trading doesn't work, or that it only works for other people, or that the whole thing is rigged. They leave. But here's the thing. The traders who push through that valley, who keep learning, who study their losses, who do the work even when it's humbling, eventually start to climb again. Slowly. Their competence increases. And this time, their confidence increases with it, but at a healthier rate. They develop what's called informed confidence. They know what they're good at. They know what they're not. They have a realistic sense of their edge and its limits. That's where consistent profitability lives. But most people never get there because they quit at the valley. Or worse, they never leave Mount Stupid. They keep losing, keep blaming external factors, and keep believing they're just one tweak away from cracking the code. So let's get specific about how this plays out in trading. Because I think if you can recognize these patterns, you can catch yourself before they destroy your account. Pattern 1. The new trader who thinks they've found the Holy Grail. You've seen this person. Maybe you've been this person. They discover a strategy. Let's say it's a breakout system or a moving average crossover or some combination of indicators. And they back-test it on historical data. And it works. It shows positive results over the test period. And immediately they think they've solved trading. They don't yet understand that back-testing on its own means almost nothing. They don't know about overfitting or regime dependency, or the difference between in-sample and out-of-sample testing. They don't understand that a strategy that worked beautifully in a trending market might collapse in a choppy one. They just see the equity curve going up and to the right, and their brain says, "You're a genius, Mount Stupid." Pattern 2. The trader who dismisses risk management because they're good at entries. This is a classic. They'll say something like, "I don't need tight stops because I can read the market. I know when to get out." What they're really saying is, "I don't yet understand that being good at entries doesn't protect you from the trades where you're wrong. And in trading, you will be wrong. A lot." The question isn't whether you'll be wrong. The question is what happens to your account when you are. Professional traders obsess over risk management, not because they're afraid, but because they understand variance. They understand that even a strategy with a 70% win rate will sometimes lose 7 times in a row. And if you're not managing risk properly, 7 losses in a row ends your trading career. But the new trader doesn't see this yet. They think risk management is for people who aren't as skilled as they are. Mount Stupid. Pattern 3. The trader who can't accept that losses are part of the process. They take a loss and immediately start tweaking their system. They add filters. They change time frames. They convince themselves that if they just refine the entry a little more, they can avoid losing trades. This is Dunning-Kruger wearing the mask of diligence, because they don't yet understand that a profitable trading system doesn't win every trade. It wins enough trades with favorable enough risk reward that the cumulative result is positive. Losses aren't bugs in the system. They're features. They're the cost of doing business. But the trader at the peak of Mount Stupid believes losses are mistakes, and so they spend all their energy trying to eliminate them rather than learning to manage them. Now, here's the uncomfortable part. If you're watching this and you've been trading for less than 2 years, there's a very good chance you're somewhere on Mount Stupid right now. That's not an insult. It's just statistics. The question is, what do you do about it? Because here's the paradox. If you're overconfident due to incompetence, you can't see your own overconfidence. You lack the skill to evaluate your own skill. So, how do you escape the trap? The answer is brutal honesty combined with structured learning. Let me break that down. First, brutal honesty. You have to track everything, every trade, every decision, every outcome, and you have to review that data regularly, not with the goal of proving you're right, but with the goal of finding out where you're wrong. Most traders don't do this. They have a vague sense of how they're performing. They remember the wins more clearly than the losses. They tell themselves stories about why the losses weren't really their fault. This is your brain protecting your ego. And your ego is going to destroy your account if you let it. So you track, you record, you force yourself to look at the actual data. It's not the story you're telling yourself about the data. And when you do this honestly, patterns emerge. You start to see that you're exiting winners too early, or that you take bigger size when you're frustrated, or that your win rate on Fridays is terrible because you're forcing trades before the weekend. These are the truths that competence is built on, but you only find them if you're willing to be wrong, if you're willing to confront the gap between who you think you are as a trader and who you actually are. Second, structured learning. You need to study trading like you would study medicine or engineering, not casually, not by watching random YouTube videos and hoping something sticks, but systematically. Read the foundational books, study market structure, learn position sizing math, understand the psychology research, and go through real trade examples, not just wins, but losses, and analyze what happened. And here's the key. Learn from people who are ahead of you, not people who claim to be ahead of you, people who can demonstrate it, people with track records, with years in the market, with the scars to prove they've survived. Because the thing about Mount Stupid is that everyone up there sounds confident. The person who's been trading for 3 months sounds just as sure of themselves as the person who's been trading for 10 years. But only one of them actually knows what they're talking about. Your job is to figure out which is which. And the only way to do that is to develop enough confidence yourself that you can evaluate claims critically. Now, let me talk about the valley of despair, because this is where it gets psychologically hard. You've been trading for 6 months, a year. You thought you had it figured out. And then you have a losing streak that wipes out 3 months of gains. Or you realize the strategy you've been using only worked because the market was trending, and now it's chopping and you're bleeding. And you feel like an idiot, like you wasted your time, like maybe you're just not cut out for this. That feeling is actually a good sign. It means you're leaving Mount Stupid. It means you're starting to see the complexity you couldn't see before. You're developing the competence to recognize your own incompetence. This is progress. But it doesn't feel like progress. It feels like failure. And this is why most traders quit during the valley. Because the emotional pain of realizing you're not as good as you thought is intense. It's easier to walk away. To tell yourself trading is a scam. To blame the market, the brokers, the algorithms, anything other than sitting with the discomfort of not knowing. But the traders who make it, the ones who eventually climb out of the valley and reach informed confidence, they stay. They keep studying, they keep trading small, they keep reviewing. They accept that they're in the learning phase and that the learning phase is long and uncomfortable and necessary. They stop trying to make money and start trying to get better. And over time, the getting better produces the making money. So, let me give you a checklist. A way to assess where you actually are. If you can answer yes to most of these questions, you're probably still on Mount Stupid. Do you think you found a strategy that works consistently, even though you've only tested it for a few weeks or months? Do you believe your losses are mostly due to bad luck or external factors rather than flaws in your execution or understanding? Do you find yourself explaining to other people how trading works, even though you're not consistently profitable yet? Do you feel frustrated when people suggest you need more experience or education? Do you think risk management is something other people need, but you can skip because you're good at reading the market? If you answered yes to 3 or more of those, you're probably overconfident relative to your actual skill. And that's okay. Seriously, everyone starts there. The question is whether you're willing to acknowledge it and do something about it. On the other hand, if you're in the valley of despair, here's what that looks like. You've been trading for a while, you've lost money, real money, and you're starting to question whether you'll ever figure this out. You look at your trade journal and you see patterns you can't seem to break. You know what you should do, but in the moment, you don't do it. You feel overwhelmed by how much there is to learn. Every time you think you understand something, you discover another layer of complexity. If that's you, stay. Keep going. You're closer than you think, because the valley is where real learning happens. It's uncomfortable, but it's productive. The traders who make it are the ones who can sit in that discomfort without quitting. Here's the final piece. Informed confidence, the place you're trying to get to, doesn't feel like the confidence you had at the beginning. It's quieter, less certain, more humble. You know your edge, you also know its limits. You know what you're good at and what you're not. You don't claim to predict the market. You just execute a process that, over time, has a positive expectancy. You're not excited about trading anymore. You're not bored either. You're just doing the work. And that might sound depressing to someone at the peak of Mount Stupid, because they're trading for the thrill, for the validation, for the story they get to tell themselves about being a trader. But informed confidence is where the actual money gets made, because you're no longer fighting your ego. You're just playing the probabilities, and the probabilities, executed consistently, eventually pay. So here's what I want you to take away from this. The Dunning-Kruger effect is not something that happens to other people. It happens to everyone, including you, including me. The difference between traders who fail and traders who succeed is not that successful traders avoid overconfidence. It's that they recognize it, confront it, and work through it. They track their results honestly. They study seriously. They stay humble even when they're winning, and they keep learning even when it hurts. If you're new to trading and you're feeling confident, be suspicious of that confidence, not paralyzed by it, just aware. Ask yourself, do I actually know what I'm doing, or do I just not know enough yet to realize I don't? And if you're in the valley, feeling lost and frustrated, that's exactly where you should be. Don't quit. This is the part of the journey where real traders are made. The curve is real. The only question is whether you're willing to walk it all the way through.